Well, Michael, welcome back. It's Courtney here, and I'm going to ask you some more questions about audit today. But before we get onto audit, I want to talk about Kenya. In Australia, we catch taxis, an Uber, maybe train it, drive it, whatever it might be. But how do you get around in Kenya?
So these days, things are more or less the same as Australia. But what is interesting is when I was growing up, so the major mode of transport was what we call matatus. And this was really, really exciting. I remember, so there would be a tout who is literally hanging outside the vehicle. So the vehicle would probably carry maybe 18 people or so. So it has a capacity of 18 people. And so what would happen is when they're getting people in, they would put as many as 30 or 40 people in.
Wow.
So we'd literally be so squeezed in together, you know, and it would be very interesting. And sometimes people would step over each other and all that. There would be a lot of mayhem and screams and complaining. Mm-hmm. Yeah, but that's pretty much how the mode of transport when I was growing up.
Yeah.
Obviously, like I said, times have changed and Ubers have now come in and taxis are there. But we still have matatus. They're a bit more regulated now.
Yeah.
Yes.
And do they still have it where you might even have to jump on a moving one?
Yes. That still happens. It's illegal, but it still happens.
Yeah. Oh, fantastic. I have seen them, I have ridden in them, and I have seen people get absolutely squished. It's hard to believe how many people can fit in one vehicle.
I know you've actually been to Kenya, right?
Yeah, that's right.
Very good.
So, a lovely place to explore. I guess what concerns me is if two matatus do crash into each other, that can be up to 80 people involved in a crash, and that terrifies me. But they are very fun and adventurous. Well, thanks for sharing. Now we're going to switch on to audit. And I guess what I like talking to you about audit is there's all the theory in the textbook, but what I want to dig into is what really happens. So as we talk through the theory, I want to, I guess, press and probe you with some more questions. But firstly, what are the three stages of audit? So
there is obviously the planning stage, the performing stage, and the conclusion. But an audit really starts, the first step is actually assessing a client. Yeah, so what the organization or what the audit firm would do is they would identify a client, or a client would approach them. And the main question for the auditors is, do they accept this client or not? So that's actually the first step.
And I'm sure they're supposed to do that based on ethical considerations, but I think it's more about, are we going to make a lot of money here?
That's actually true, yeah. So the key considerations are normally, are management, or is management, are there any integrity issues? If management is of integrity, then that's a tick. Mm-hmm. The other thing they would look at is, can they actually service this client? And this could be for a number of reasons. So one of the reasons could be that they deal with very complex transactions. So it could be, for example, derivatives and all that. So you might find a small audit firm might say no, not because there are issues with integrity, but because they can't service that client.
Yeah.
Another reason could be that the organization is very large compared to, say, the audit firm. So for example, you can imagine an ANZ and a small audit firm of about 2 partners, and that they can't really service that client.
Oh, exactly. So, I mean, if you have a supermarket that has hundreds of stores and thousands of employees, you need a big enough audit firm, or a company that's got multinational, so it's going to have transfer pricing and taxation. You need to have a breadth and depth to cover that. I see that.
Yeah, that's actually correct. So I worked for both EY and KPMG, and yes, I could definitely see that there are times when we had to travel overseas to actually work on a client. Sometimes we would actually engage another auditor outside. So I remember when I was with KPMG Australia, we had a client that had a subsidiary in Indonesia, in China, and a few other countries, and so we had to engage other auditors to do the work, mostly from the Big Four, but then they would actually provide the information back to us on how the audit went.
And that's an interesting sign. Often when we see a corporate that has done illegal dealings or gone bust, or something's gone wrong, we often find they have a very, very small audit company, maybe 1 or 2 people. And straight away, I see that as a red flag or a warning sign. So, all right, so now, still, you're assessing the client, but you have to win the client. So I'm always interested, does the auditor go and present and try and win the work? Or do you wait for the client to say, hi, come and quote me on on an audit, please?
Yeah, it's a good question. It's normally quite subtle because accountants there's a limit to what you can do. So, for example, you can't really try and market as much as possible. I mean, as much as normal businesses do.
Yeah.
So it normally tends to be a personal relationship. Maybe the partner with the CEO, they could meet at a golf club or a certain club.
Yeah.
And then through those conversations, it happens. But generally, it's not a presentation. No.
Yeah.
Yeah, it's very different.
And so from my personal experience, I have been involved in an organisation where I actually went and sought out an auditor and requested tenders because I wanted a good quality audit. We actually encourage them to come and look carefully because this is so important. But I'm sure there are management who aren't keen to have auditors look carefully. Have you ever seen sort of pressure to not look too closely?
Well, with my experience, because I've worked for, I guess, multinational companies, the standards were quite high. But I must say, when I was working at EY and at KPMG, some of the small clients, you would see the resistance, especially from the CFO or the CEO, like, why are you asking this and what does that mean? And sometimes you might find that there may even be an error and they're still trying to justify why it's actually not an error.
Yeah.
And this is especially when it starts impacting their profit before tax.
For sure. And their bonuses or market perception.
100%.
All right. So we've assessed the client and now we enter the planning stage. So stage one, planning, when does the audit process start?
So once you've accepted the client and you're like, I'm happy with this client, you've gone through the process, you've ticked all the boxes, then the next phase is obviously the planning stage. Now, the planning stage is really now determining what's going to be the objective of this audit, what's going to be the scope, what's going to be the timing, and the like. Now, for the audit of historical financial information, very easy. It's always the same. It never changes. And so it's quite easy when you're doing that because the objective never changes.
Yeah.
You'll find even the scope might potentially not change. So it just depends with whether it's a large client or a small client, but you will ideally look at all the material figures of the financial statements. So that's actually the first step. So what auditors tend to do is they will have a quick look at the financial statements. It may be last year. So I'm talking about a new client here. So there may be an annual report, a previous year's annual report. Maybe it was audited by someone else, another company. So they would go through that. They would go through all the information of the client. And then they would prepare what we call the engagement letter.
Okay.
Now, the engagement letter is actually what stipulates the objectives of an audit.
Okay. So then one of the things you mentioned was scope. And I can imagine the auditors, they want to look and check and test a whole lot of things. And management are like, oh, please don't look in that cupboard. Don't look under that sink. Don't look in this dark corner. So what do management do to try and limit the scope, I guess?
So it could happen many times. If management want to limit the scope, it could be because they are already aware there is an issue around that. So it could be, for example, they might actually stop someone from attending a stock take.
Okay.
Yeah, and that's because probably they've overstated inventory.
Yeah.
Or they've significantly
So this actually happens. They'll try and stop the auditors from attending the stock take.
They can definitely frustrate the auditors.
Wow.
Yeah, or they can say, oh, it's overseas, the warehouse is overseas, you can't get to it and all that.
Yeah.
But I must say, as auditors, there are always ways around that. So if it's the audit of historic financial information, then the auditors have to ideally still check that the value of inventory is correct.
Yeah.
And there is a risk because if management persist on that, then you might find that the auditors could actually qualify the financial statements.
So that's the threat. So going back over 20 years for me, I've been involved in a stock take and the auditors came and management were quite clever. Well, you see, we're in a warehouse. The warehouse is dirty and the auditors all wear suits. So we said, come on, auditors, jump into the cherry pickers, the machines that take you up and down, and they didn't want to.
Yeah.
So we were up in the pickers counting the stock, telling them whatever we wanted the stock number to be, and they just watched us do it.
Yeah.
And, there was a significant amount of stock in there that I would call obsolete. Probably 10% of the stock was obsolete.
Yeah.
But the auditors didn't know, one, they didn't really know the business, and two, they didn't get in the cherry pickers and actually have a look. Is that something you've seen?
Yeah, and Courtney, you may have seen quite a number of scandals just emanating from something like that, where junior employees are given a certain financial statement item to review, while the risks around this particular item are quite significant. So normally with an audit you'll find a very senior, it could be the partner or the manager in charge of the audit. They would ideally look at all the financial statement items and assign the risk levels.
Okay.
So if inventory is at a high risk, if that's considered to be has a high risk, then ideally you should assign someone with quite significant experience in that. But what tends to happen is auditors sometimes try to save money, to reduce the cost. And so they give a very junior person. And in such a case, I have a feeling that was probably a few junior people trying to attend a stock take, and they have no idea what to do.
Yeah, and it was interesting to me because I think I have a more cynical mind. I would have got into the cherry picker if I was an auditor trying to find out what was going wrong. It's exciting. For me, it's a little bit like a police cops and robbers kind of situation where, you know, the auditors are trying to check and the management are trying to hide things, and it's a bit of a game being played. So it makes it interesting.
Yeah.
So what could go wrong in the planning? You're doing the planning stage. What are, you know, potential errors or mistakes or problems that might arise?
Many times it's around the risk assessment process. So if the auditor doesn't get the risks right, that can have a serious significant effect on the audit opinion. So it's very important for the auditor to correctly identify or come up with what is the inherent risk of this organization. So this is looking at what are the complex transactions, what are the areas of where they use a lot of estimates, what are the areas where maybe they have a lot of provisions and all this, because these are the areas that can be manipulated. Depreciation, provision for doubtful debts, that kind of thing, impairment and all that. So as you know, management know how to manipulate the profit before tax. And so they can actually use these items. And so if you get that wrong, then the whole audit process will be actually incorrect or wrong.
Well, and that one intrigues me. There's a company I know most people would, Xero, the accounting company, and they've got amazing subscribers and they're worth, I don't know, $10, $20 billion worth of market capitalization. But one of the interesting things they do is they capitalize a lot of their employee labor as an asset. Now, is it legal? Yes. Is it in the standards? Yes. Does it sort of raise a red flag for me? Absolutely. And it's interesting when they announce really strong EBITDA figures, but in that EBITDA is a capitalization of assets. If you properly wrote off the employee expenses, their losses would be well over 100 million a year. Like we're talking big dollars.
And that's why you find the spirit of the accounting standards is exactly that, to really identify should items actually be capitalized or expensed. So again, if you are dealing with probably junior employees or people who don't have the experience, so you see, you're talking from a management point of view, you really have that experience, you know what you can potentially play around with. But some of these auditors are very young, they've only been there for 3 years, 4 years or something like that, so they still don't have that fundamental knowledge of how to, I guess, apply creative accounting.
For sure. I've had to work with auditors where I've had to explain to them how it works and how we do it. And I'm quite happy to be open and honest, but it would be very easy to say whatever I wanted because they're still learning the ropes. So I haven't had much experience with auditors who have deep experience, because I think once you've audited for a few years, you either quit the industry or get promoted, and then you stop doing the technical work and you're more of the salesperson, or you're at the golf day.
And that's true. And that's why you will find for some organizations, especially if they really want to know what's happening, there are times they will actually go to a mid-tier firm or a small audit firm rather than the big four, because they know with the big four, you know, the partner will come initially, but then it's the junior people who will actually do the audit. Whereas if it's a small one-man, two-man show, then you find that this senior partner is actually the person doing the work, and they provide a lot more beneficial knowledge to you and intel to the owner of the business.
Well, if I ever decide to try my hand at it, I think I've seen every ruse. Because I've worked in management, you see everything you possibly can, and it would be fun to turn over all the rocks and point them out. So, and I guess this leads to the idea of materiality. Does the auditor decide materiality or the management?
So the auditor decides materiality, and materiality is really what is this threshold that if it is exceeded, it could make a decision maker, or rather a user of financial statements, make a different decision. And so that's what we refer to as the materiality level.
But I'm going to stop you there, because that's going to need a lot of judgment. There's no number there. Then it's not like 3% or 10%. It's whatever is going to shift the dial, change the decision.
Yes, that's correct. So generally speaking, there is guidance. So you might find like generally they tend to use a profit before tax, and it will be around between 5 and 10%. Now, what we used to do is, if it was a new client, we would obviously move towards the 5%, the minimal lower level. Whereas if we have experience with this client, if we've seen this client, we know that they don't have issues of integrity, the controls work and all that, we would move around closer to the 10% level. So that's how generally it works.
Okay. And then what about, I've heard people say fraud, even $1 of fraud is material. Whereas let's say it's a $10 million turnover company. If your leave balances are out by $5,000, I guess who cares? But if there's fraud, where would you set the materiality?
So if there is fraud, there are two types of fraud. There is a fraud where it's probably a junior employee doing a fraud, and you'll find for most organizations, fraud tends to happen. It's just that people are not aware. There are reports that are normally submitted or rather published every year, and they sort of say that every organization loses about 5% of its profit when it comes to fraud, due to fraud. And so fraud is quite normal, but what tends to happen is if it is being perpetrated by management, then that's a big issue. And so the auditor will not consider so much a quantitative threshold. This will now cause the auditor to probably even qualify the financials or to raise that red flag if management are involved. So if the CFO is involved or the CEO.
Okay, that adds a little bit of subtlety, isn't it? Because if the management are involved, they have more power. They can override the controls far more easily than an employee. So just going to go back to Kenya for a moment. When I visited Kenya at the time, in the newspaper, they actually published the most corrupt people list on the front page of the nursepaper. But everyone kept doing it. They actually listed who was the most corrupt and how much money they'd stolen. So maybe in Kenya they have an interesting approach to fraud.
Yes. And to be honest, it's not just Kenya. I think it's also in Africa, where you tend to see that everybody wants to get wealthy. I guess everywhere people want to get wealthy, but it's just how to get wealthy. So you'll find that a lot of the politicians especially, they will use public funds and all that to get wealthy. And I guess, it's sort of permeated into the culture where people really are keen to make it.
And I've heard, and I can't speak to this too confidently, but in Indonesia, for example, whilst there used to be quite a bit of sort of corruption where you paid a lot of bribes, it was actually quite structured. For different levels of people you dealt with, you knew how much to pay. So in a sense, in Australia, if you want to get your passport done, let's say it costs $300. But if you want to do it faster, in 2 weeks instead of 6 weeks, you pay $350. If you want it same day, you pay $500. So if you go to another country and you want to get something done quickly, you pay a facilitation payment, you pay a bribe. But I would say it's exactly the same thing. But in Australia, it's formal.
It's formal and legal, yes.
But you still pay more for the quicker service.
Yes, that's so true. I mean, in Kenya, it's exactly the same. You just approach someone there at the counter and say, what if I paid this? And then so there's a negotiation. It's very interesting. It's a very informal process. But it's obviously all illegal. So, and I remember when we would catch the buses, the driver would have to have a clipboard with a whole lot of cash underneath it. So, because they set up random police checkpoints. Which I would just call so in Australia, I drive to the city and my e-tag beeps and it goes beep and it takes the money. So to me, it's exactly the same. It's an interesting way you've looked at it. Well, in Kenya, people say, I'm just paying taxes. It's just part of paying taxes.
Exactly. It's when it becomes too much or it's unexpected, then it's not fair.
And you find many times it's because the fines are so prohibitive that you'd rather just pay the bribe. Because if you go through the legal way, then if let's say you have breached a certain law, the fines and the penalties are really, really huge.
So tell me, it's one thing to read in a textbook. You're an auditor, you've discovered a fraud issue and it's perpetrated by management. Have you ever experienced this? It'd be stressful because management have hired you to audit and now you found a fraud. What do you do now?
So I've actually experienced it. And what tends to happen is once you've identified it, the first call is to talk to those charged with governance. So this would be like, say, the directors or the people who sit at the board of director level. And so you would actually highlight it there. And this would be through a formal process. Now, depending on what they want to do, most of the time there will be action that will be taken, but that will also find its way into the management letter, as well as potentially it may result in the qualification of the audit opinion.
And then do you see in those situations, do the management get fired? Do they negotiate their way out of it? Are they friends with the people who are in charge of governance?
So that it's a very good question. So for this case that I did, it was actually a wine company that was owned by the government. And so there was no firing, no one was fired and all that. There was just a bit of delay and all this. So you're never quite sure how many people are involved in it. Yeah. And so that's normally the problem. Yeah. And so the only thing the audit firm can do is decide whether to continue with the client or to stop all relationships there.
Understand.
And as you know, chances are
you're going to keep doing it because the money's good.
Yeah.
All right. So it shows that the work is being done. I think that's what the thing I like the best is the auditors do the work. They do check, they do test, they do find this. I'm not always happy with the outcomes because it's a political game, but at least the auditors know what's going on.
Yes.
So how do the auditors decide whether to rely on controls during the planning phase? Because lots of companies have policies. I've seen policies that I never need to see another policy for the rest of my life.
Yeah.
But are they actually put in place? Yeah. How do you know?
So what tends to happen, if it's a new client, then there's no way you will know whether the controls are effective or not. Because remember, controls, we're talking about whether bank reconciliations are performed, whether ledgers are being reconciled and all that. So there's no way of knowing that. So you will find when the auditor is preparing what we call an audit strategy, they will assume that the controls are not working. So they will have to test them first. If this is a recurring client, that's different. Because the auditor will assume initially that if controls worked last year or in the previous year, then they will work this year. So that's how they will approach the audit strategy. And that has a significant implication on how the audit will actually be performed.
So in our business, we've hired penetration testers, software people who come and hack our site. And so do auditors get to do that? When you test controls, do you try and bribe people? Do you try and steal money from the organization?
Well, you don't actually try and steal, but you actually try and see whether you can steal.
Fantastic.
So you definitely have to do that. And it's good. It's interesting you're talking about penetration testing and all that. You will find really good auditors. We'll also have some IT people from the audit firm also testing the system, whether it can be penetrated, because you're still looking at the overall risk of this business.
Yeah.
Of course, with small audit firms, they may not have the capacity to do
the systems.
That. Yeah.
So a really good example I've seen, like when I worked in a school, one of the questions I asked myself is, how would I steal the money? The quickest and easiest way, and then how would I stop that? Now, we send out invoices to all the parents. So, several $1 million is going to be collected. Now, what if we change the account number on all those invoices? Who's checking? Who's texting that? Who's making sure that's not done? Now, that fraud would get detected reasonably quickly. Yeah. But if someone took the money and left the country, they've still got $1 million.
Yes.
So it's a one-off fraud. But that's a good example. Or suppliers or employees. Now, with employees, they're going to know every fortnight whether or not their BSB and account numbers change. But they won't with the superannuation.
Yes.
So you could easily be taking the superannuation by just changing some numbers. So how do the auditors, do they check that? Do they check for changes in BSBs and account numbers and false suppliers and made up employees?
Yes, they definitely do that. And what they tend to do is, as part of performing the control testing and all that, they will actually test the IT environment and they will test the accounting system. So they may use dummy transactions, they may use test data and all that. And they will actually assess both the environment and the controls themselves. Now, most of these controls are automated, so the auditor will try and actually do something to see whether these automated controls can be flexed or changed.
I see. So they could try and change the BSB and account number or something. Yes. And then if it comes up with a warning or a rejection, you know it works.
And for most organizations, I remember when I was working as a group audit manager, we recommended that an email is sent out immediately to the head of finance, or rather the head of that finance team, if a BSB is changed, so that person, so it would be the finance manager in that area, immediately knows something has happened. And so they would go and talk to the employee, what happened here? And then the employee would potentially say, and it could be legitimate, it could be that the client has reached out and changed the BSB number and all that, yes.
And that's something, so one of the controls we brought in during COVID, because people were emailing everything through, was nothing gets actioned if an employee changes their bank account or super fund or anything like that. Nothing gets actioned unless the form is personally handed over and signed. Everything via email is assumed to be fraud, because someone could easily hack your email account, email me and say, change my bank details.
Yes.
So we actually went back to the old days of paperwork and printouts and signatures, because electronic is so easy to abuse.
It's interesting because when all these IT things used to come up, we used to say, automated controls are the best.
Yeah.
Now, you're saying, we're going back and thinking, hey, I think I still need physical evidence, not just the automated controls.
I like the both. So one of the things I learned that auditors are fantastic at, that they can download the whole supply payment system, and then they cross-reference that with the employee bank account. So you can find if someone's also trying to sell to the business.
Yes.
But one thing we did discover is which people in the company have started living together without, who might not be, because the payroll goes into the same account. Just little things like that happen when a big audit firm has the right software.
Yes.
You can check millions of transactions rather than one at a time.
And what I found when we were auditors, we used to do that, and that data analytics was also more to gain other business within the business. So it's not just the audit. So we show the business using this software, you could get this and this, and then potentially on the side you say, hey, can you call us and we can look at your procurement procedures.
Fantastic. Cross-selling. Here we go.
Yeah.
That's how it should be. And look, I like it when it adds value. So if you come in and you help sort of penetrate, test the accounting software, great. Test every other software too, because if they can hack in and steal the customer database, that's incredibly valuable. Yeah, if you can help solve that.
Yeah.
But as long as you don't lose your auditing skill.
100%.
All right, so we're that's the end of the first stage, planning. Now we move into the performing. It's time, you've turned up, you've put your suit on, because you always wore a suit, I assume.
Most of the time, yes.
Yeah, even if it was time for stock take in a dirty warehouse. Evidence. Everyone talks about evidence. What is this?
So, in an audit, similar to in a court of law, you have to have evidence, and this evidence must be enough. In audit, we call it sufficient, appropriate audit evidence. And so you must meet that criteria. And so what tends to happen is the auditor will perform the test that they are doing, but they will actually be gathering evidence. And so they have to gather enough evidence that if an external party was to come and look at the evidence, they would also conclude that, yes, this works or this doesn't work. Yeah. And so that's very, very important.
All right. And I'm happy with that. And one thing I've seen over time is, in the past you used to do sampling, but sometimes you don't even need to sample because of IT. You can test a whole area. You could look at every employee or every supplier.
Yes.
Yeah. So sampling, is that something linked to evidence?
So sampling is definitely linked to evidence. What tends to happen, I like what you have mentioned there, because of IT now, you can literally put all the data in and quickly look at what we call substantive analytical procedures, where you quickly look at the relationship between the different inputs, the different variables. And if everything makes sense, then that gives you evidence that things are working well. Now, a lot depends on the risk that you have assigned to that particular financial statement item. There are some financial statement items that will be enough. You don't need to perform any more audit. But there are some where, even though you've done that, you still need to pick a few and actually trace that to original documents. So it just depends with what you're looking at.
All right. Sometimes you have to deep dive.
Yes.
A little bit of an aside here, and we'll explore this a different time, but my high school that I went to has had a business manager or a bursar or whatever. They've gone to jail for a very, very long time. And that's because they maybe took a bit of money that wasn't theirs. But interesting that the auditors didn't detect this for 10, 15 years. And one of the simple things I read in the newspaper was single sign-off on payments. As an auditor, what would you say if you came across an organization where one person was able to make payments all by themselves?
Oh yeah, that's just unacceptable, completely unacceptable. In all the audits we used to do, and that was part of the audit program, that there must be at least 2 people who need to sign before money leaves the organization.
So this lady's gone to jail, and rightfully so. Should the auditors go to jail as well?
For not detecting it?
Yeah.
Well, I guess the audit...
You weren't expecting that question.
That would be interesting, yeah. That would be interesting.
I'm going to say yes. Because think about this. They looked at it. You knew straight away. I asked you. I gave you the scenario. And you're like, oh, totally unacceptable. So you knew. And these are proper trained auditors. So they knew and they said nothing. I would love it if they went to jail, because then every other auditor, if they ever see this, wouldn't let it happen. You know, over $500,000, I think, roughly $500,000 stolen that they know of.
Yeah.
That's not okay, especially if you're the auditor.
But you and I know that very rarely do auditors ever go to jail. What tends to happen is they have these very good insurance covers.
Exactly.
And
that's how they solve the problem.
Yes.
But imagine a few auditors went to jail.
Yes.
What would you do as an auditor if your friend
I think you'd be more careful, definitely.
Absolutely. I'm ready for it. I think if there's an obvious oversight where, you know, you're
a
reasonable auditor test. Would a reasonable auditor who has got even 3 minutes of training have known better?
Yes.
Go to jail. So here we go. So what could go wrong when the auditor is performing the audit?
So what could go wrong here is, let's say you're performing a test of controls. It's very possible for the auditor not to potentially say that the controls are working when they are not actually working. Now, if that's the case, what tends to happen is the auditor will reduce their what we call their substantive procedures. And that will have a very significant implication on the audit results, because that means that they didn't actually, because the substantive procedures are where you literally look at documents, original documents. It could be titles, it could be invoices.
See, this is auditors inventing fancy words. Got to tell you this. Substantive procedure sounds fancy. But what you're trying to say is you have to substantiate this claim with documentary evidence.
100%.
That's all you're saying? So
and that's why AAA is a very technical subject.
I would like
because
to
of those
rewrite
terms.
AAA with like my words. So there is substantive where you like really, really check.
Yes.
And then what's the other one where you pretend to check? What was that one called?
That's substantive analytical procedures.
Where
you just look at the numbers.
You look at the numbers. And
you look at the employee expenses, you look at the number of employees.
Looks right.
You do a logical assessment. You're kind of reasonably, it looks all right.
And most of the time I do that. And I use instinct. I call it instinct and gut judgment, but it's not. It's just decades of experience. So I can look at numbers and say, the debtors are wrong. The debtors are overinflated. I can look at inventory and know that there's obsolete stock. And I can get pretty accurate. My gut tells me. But where you get caught out is if someone's been doing a fraud, for example, this person for 10 years or more, all your comparisons over the last decade look the same because the money's been stolen for 10 years. So that's why you have to dig deeper.
Yeah, and that's why when I was an auditor, we used to have this thing called, every year you introduce an unpredictable test.
Yes.
And so that used to help, especially when it comes to fraud.
Yeah.
But how many auditors do that? Where they actually think outside the box. They're like, okay, we've been doing this test, but let's introduce this. And that tends to be where cash is involved and revenue.
Yeah. Any type of thing where you say, I mean, you could brainstorm with 5 people and say, how could we steal money out of this organization today? What would be the simplest, easiest way?
Yes.
And then just go and dig for a little while.
Yes.
Yeah.
Correct. Yeah.
I think knowing that, a little bit of curiosity or professional skepticism and the fear of jail, I'm going to come back to that. I'm really liking this idea.
I think the challenge for especially big big accounting firms is the turnover.
Yeah.
So they don't really retain people for a very long time, and so that knowledge is always lost.
Yeah. How curious? I mean, if you're following the corporate process, you're not going to stop and think and be curious and go, how can I just introduce a bit of creativity here and investigation?
And sometimes, you're on very restricted time, there's a budget, there's all that. So as much as you want to be creative and you want to think outside the box, you know that if you go over time, then that's an issue with the partner. So you sort of actually want to beat the time that the person who did the audit last year. So if they took 120 hours to finish an audit or 2 or something like that, you want to do it for less so that you can get your bonus and all that. So conflicting
lots of
KPIs
conflicting
there.
layers. See, once again, if you were scared of going to jail, you'd work a little bit longer.
100%.
All right, so we get to the conclusion of the audit. A couple of questions here. How does the auditor cover themselves to show that they've looked at all the appropriate information?
Yeah, and this is an interesting one because remember, the auditor is just looking at information that management have given the auditor. So the question is this actually the right information? So to cover themselves, they have what they call a management representation letter. And this letter is signed by management, and they actually state that we have given you the correct information. We have given you all the information. There is nothing that we know of that we haven't given you. So that is a letter. And so if there is ever an issue later, if people have to go to jail, then management will go to jail for withholding information.
All right. Yeah. And I quite like that. I just wish that letter was, or some version of it was public. I'm still not convinced that the audit document at the back of a financial report is informative enough. It's tick or cross. It's pass or fail. It doesn't have enough.
But you'll find with this letter, it's very standard as such. So it's basically management saying, we have given you all the information. We have not withheld any information. We are not aware of anything that would be detrimental or would impact the audit and all that, yes.
All right, so it's time to give an opinion. You've done lots of hard work, and we've talked in the past about qualified and unqualified, but there's also adverse opinion. So tell me, when are you going to issue a qualified opinion? When are you going to do an adverse opinion?
So both qualified and adverse mean that something has gone wrong, that the financials are materially misstated, which means that they did not get to that bar that the auditor required. So when you qualify the financial statements, what you're saying is that you found issues that are material, but even though they are material, they are not so big that they affect the whole the financial statements as a whole.
So it might be staffing expenses are wrong.
Yes.
Really, really, really wrong to a material level greater than, let's say, 10%.
Yeah, and the term we use in audit is pervasive. So they're material but not pervasive.
Okay.
With adverse, it's material and pervasive.
Okay.
Yes.
There we go. So adverse is worse than qualified.
Yes. Adverse is actually really bad because essentially you're saying to the users of financial statements,
don't
throw this into the bin.
This is rubbish.
Yeah, this is rubbish.
Okay, I'm glad that. And have you ever been able to issue one? It would have felt good.
I've issued a disclaimer of opinion. I've never really issued an adverse opinion, because what tends to happen is management would probably want to fix that, because essentially they're telling the users that
this is garbage.
Yeah, this is garbage. Don't look at this financial.
So you threaten management with the adverse opinion,
yes,
and then they listen to you and change the numbers.
And if they don't, especially if they are withholding information, then you can issue what we refer to as a disclaimer of opinion. So essentially you're saying, I'm not giving an opinion. I wasn't given the information.
So you've actually issued one of those?
Yes, I have done that.
Yeah.
Yes.
All right. And that would be quite insulting. I mean, anyone looking at that report would say, the auditors have said these people can't be trusted. They're not giving me the information.
Yes.
All right. So material misstated versus pervasive, qualified versus adverse. There's quite a hierarchy and a ranking of different types of opinion.
And there are very many interesting things that you look at. You look at, for example, going concern. So as an example, a very good example is, it could be a business like a coal business, but let's assume that there is this concern that coal mining will be prohibited.
Yeah.
So that's a going concern issue, because you have a coal business here. It hasn't yet been prohibited, but it looks like there's a bill in Parliament, and it could be passed and it could become a law.
Okay.
So that becomes a going concern issue. So you can't say that this business will not continue to operate, because it's not yet a law.
So, but you're looking in the future, so you don't just look at the past.
100%. So you look into the future.
So scenario. In Victoria, we've just said that there's going to be no more gas turned on in the future, right? And therefore, if you're in the business of doing new gas fittings and connections, you could have had profits for the last 10 years, and you might still raise a question about going concern into the future because the law has changed.
Yes. And so what tends to happen is, if in such a business, what the auditors will insist on is that there is a disclosure regarding that in the financial statements.
Yeah.
So there will be a disclosure around materiality regarding that uncertainty, or rather the going concern regarding that uncertainty. If management decline, the auditor will qualify the financials and will actually state why they're qualifying those financials.
Yeah.
They will. So it's in management's best interest to look like they are the ones who voluntarily want to inform the users, as opposed to the auditors forcing them to inform the users.
So we talked about the disclaimer of opinion. Is that what happens when the auditor fails to receive important audit information, or is that different?
But then again, it has to be material and pervasive.
Okay.
So there are two. If it's just one financial statement item, and it wasn't very significant in number. For example, it might be material, but it's not really holistically material to the financials. Then the auditor will qualify and say, we did not have access to, say, inventory. But inventory probably was material, but not really such a significant number.
Yeah.
If, however, it's quite a number of transactions in the financial statements, they will issue a disclaimer of opinion.
So you, once again, professional judgment comes in. You've got to work out if this is a material issue or not, or a pervasive issue or not.
And that's why you've seen a lot of these scandals. It's because of that. You really need someone quite senior, really has good business acumen, really understands how things work to make these judgments. When you leave this to a junior employee, that's when things really go wrong.
For sure. All right. Well, it sounds like you've made it to the end of the audit. So my final question is, I don't know if you've watched the cricket, but recently the Australians weren't invited to have a drink with the English after the Ashes. Do you get invited out for a drink with the management team for a hard job well done?
Yes. That happens. And as long as you are careful with not receiving gifts, and if you receive something, then it should be of nominal amount.
Yeah.
So, for example, it could be a pen and all that. That's fine. But for example, you don't want a crate of wine or something like that. Then that goes beyond.
All right. Yeah. So there is a celebration.
It can affect your independence.
All right.
Yeah.
So and does it normally end well, or do they slam the door as you walk out?
If you've issued a clean bill of health, an unqualified opinion, an unmodified opinion, then most of the time they're very happy. But if it's qualified or adverse, probably there will be no drinks after the audit.
And have you ever seen it, if you've had to do the hard news, do they then fire you and you don't get asked back the next year?
Well, it really depends with those charged with governance. So if they are on the side of the auditors, then they will fire management. But if they are colluding, yes, they will actually tend to try and it's very subtle how they do it. They introduce it as part of the AGM agenda.
Yes.
And then they sort of say it would be good to change the auditors to experience something
some rotation.
Yeah, some rotation, and then out you go.
And here we go, and they play the game. So if you were, advising someone reading financial statements, looking for the clues. So the thing you'd want to see is if they're rotating through auditors rapidly, big red flag.
An issue. Yes.
Okay.
Yes. So that would be a major
and
issue.
And if the auditor looks too small for the size of the organisation, that's another red flag.
Yes. And then there are also issues like key audit matters. So when the auditor performs the audit, they would actually raise what they consider to be significant, where they spent a lot of time and what was complex. And you will find this as part of the key audit matters in the audit opinion.
Okay.
Those are very important to look at, because you might find that the auditors might have tried to use a language so as not to qualify, but they're actually major risks.
So if you know what you're looking for, you can see it in there.
Exactly.
I think it's time, next time when we explore this, let's pick a few ASX listed organisations and let's see what the auditors have to say about them.
That would be nice, yes.
All right. Well, thank you, Michael, for exploring audit with me today.
Thank you, Courtney.